Hi, everyone. I'm David Toll, publisher of Private Equity Career News, and I'm going to be your host and moderator today. You've joined us a little bit early. We are going to get started at just about the top of the hour, but I wanted to greet you here and also reward you for your early arrival with some personal insights into our featured speakers. I'm going to ask each of the speakers to quickly tell us about a hidden talent or passion that they pursue outside of work, so we get to know them a little bit. Let's start with Jay Hernandez. Jay, outside of work, what do you do?
It's usually chasing my kids around. I have two teenagers right now, so whatever sports they're into in a given season, that's what you'll find me doing outside of work. Whether it be field hockey or lacrosse or swimming. That probably could be said for most of us here on the phone.
Okay, that's a good one. Nadim, I know you have kids too. What's your hidden talent or passion you pursue outside of work?
I personally, and maybe I'm the only person on the planet to think so, I have a hidden talent. I think I'm a really good dancer. You especially get some 90s, like, I grew up in the late 80s and 90s, some hip hop or some of that old music going. And I feel like I have great moves. My kids, by their looks, when I do that, I don't think they agree with me, but what do they know? This generation doesn't appreciate what a good dancer looks like, I think. So I'm going to go with my dancing abilities.
Okay.
We have to put some music on and sort of judge it, right?
I'm a guy who appears to be sitting in like one of those high-end video gamer chairs. I'm not buying it. I'm not buying it.
Well, Nadim, we can't see you. Do you want to give us a little sample?
Don't do it. Don't do it. You're a young man.
Something moves me in this panel, sure, why not? Let's do it.
All right. All right, let's move to Dave Santoni of Hennepin Partners. Dave, outside of work, what do you do for fun?
Yeah, like Jay, I have one teenager left at home. I have one in college and one out of college, so I spend time traveling to watch my older daughter play club lacrosse. My younger daughter plays tennis and lacrosse, so tons of time spent doing that. Jay will attest I'm not a good golfer. I do play golf. I guess my hidden talent, I'm a huge horse racing fan, and I've participated each year for the last 5 years in the National Horse Racing Championships in Vegas and finished in 10th place 2 years ago. Got the Breeders' Cup coming up a week from this weekend, so looking forward to some horse racing.
One of the great mid-market stories of all time involves Dave Santoni, law school tuition, and horse racing.
All right. Can we get that, Jay, in 2 minutes?
Nope, not a chance. You gotta save it.
Not suitable. Not suitable for a professional audience. All right, and everyone, thanks for joining us a couple of minutes early. We're just learning a little bit about what our featured speakers do in their spare time, and we have Jay Jester of Plexus Capital left to go. So Jay, what's a hidden talent or passion you pursue outside of work?
So I'm a full-on empty nester. My last child graduated from UVA in May, and I had all kinds of visions for these cool things. I was starting to learn how to kiteboard, which has been great fun. But much to my disappointment, it appears that the highest and best use of my time is as a mover. So I'm still like helping kids move from one place to the other. I'm helping grandparents move cities, and it just sucks. I thought I was going to be like on the old man kiteboard circuit, and I'm just a box mover up and down stairs for 6th floor walk-ups in New York, and it's a big disappointment.
Okay.
I'm also pretty good paying for dinner. That seems to be another skill that my family really values.
Very nice. Well, I'll be relocating from Charleston back to New Jersey, so I may need your help.
I'm your guy. Big, like heavy, and I can assemble like Wayfair furniture like a champ. So
All right, very good to know. So thanks everyone for joining a little bit early. We're going to get started in just a few seconds. I'm David Toll. I'm the moderator and host of today's program, and really appreciate everyone who's joined so far. Okay, let's get started. So good morning. Welcome to a special private equity career news webinar. It's called How to Land More Great Deals in 2024, and who doesn't want to do that? I am David Toll. I'm the publisher of Private Equity Career News, and I will be your moderator and host for the program. I'd like to start out thanking our sponsor, Sutton Place Strategies, SBS by Bain & Company. They are an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. A few housekeeping announcements before we jump into it. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything they say today in an article. Second, you can download a copy of today's slides from your control panel. Also, you can download a copy of the results of a 2023 survey of business development professionals. We did that earlier this year. Has some good data on industry practices when it comes to deal origination. Third, later today, I will send you a recording of the program, so no need to take extensive notes. And finally, many of you, when you registered, you asked really good questions of our panelists. I've written those down. We will plan to address those questions during the discussion portion of the program, but also we can take questions live, so please feel free to do that at any time during the program through the question feature on your control panel. Okay, I'm grateful to have 4 expert speakers today to guide you through our topic. Jay Jester is partner at private equity firm Plexus Capital. They're located in Charlotte, North Carolina. Many of you know Jay as a pioneer of the business development role in private equity. These days, he's doing much more than that, and I'll let him tell you about it in just a moment. Jay Hernandez is managing director in the Boston office of mid-market investment bank Raymond James. Jay heads up the industrial technology practice there within the Diversified Industrials Group. Nadim Malik is founder and CEO of New York City-based SBS by Bain & Company. After some brief introductions, Nadim will present statistics describing the state of the M&A market and also address the role that technology plays in helping deal originators see a higher percentage of relevant transactions. Dave Santoni is managing director in the Minneapolis office of lower middle market investment bank Hennepin Partners. Earlier in his career, Dave spent a number of years heading up financial sponsor coverage for Lazard Middle Market. Okay, let's find out a little bit more about our speakers directly from them. Starting with Jay Jester. Jay, tell us a little bit more about Plexus Capital and what you do there.
Yeah, so Plexus was started in 2004 as an SBIC fund, mostly focused on the independent sponsor market. The core business at Plexus is sort of credit first, teaming up with independent sponsors. We deploy about 2/3 of that capital as junior debt and 1/3 is equity. That's the base business. In 2019, after 20 years with Audax Private Equity, I had a chance to sort of, my story is move back home to the South. I'm originally from North Carolina, and then also moved back home to the what I finally call the dinky deal market, and came back. And between 2020 and early 2022, we raised a control equity fund to manage alongside the credit strategy. And so we've got we're about 60% through our fund one. We've completed 7 deals. We kind of focus on the equity side in the $2 to $7 million of EBITDA range. And it's been a lot of fun. The team's up to 47 people. We do have, and I think we're still listed as headquarters in Charlotte, where we used to be, but actually 40 of our 47 team members are in Raleigh, North Carolina now, which has been a great market for us.
Nice. Sounds like you've been busy, Jay. Let's turn to Dave Santoni. Dave, tell us a little bit more about Hennepin Partners and your role there.
Sure. Hennepin Partners is a Minneapolis-based lower middle market investment bank. We focus, and our definition of the lower middle market is sub 300 million enterprise value transactions. We're roughly 40 bankers, and what makes us a little different than others is we're top heavy. We have, of the 40 bankers, 13 MDs and 2 directors, and really going back to the old school way of doing small deals and promising and delivering senior attention to deals. Hennepin was formed in 2018 by a bunch of former ex-Lazard colleagues. I believe we have 11 former Lazard middle market bankers here that are all MDs or directors. We'll do primarily sell side investment banking, 20 to 30 deals a year, focusing on both PE exits and entrepreneurial exits. Prior to joining Hennepin, I spent almost 17 years in the financial sponsor coverage group at Lazard, running the lower middle market efforts, which is where I got to know Jay back more than 20 years ago. Happy to be here.
All right, thank you, Dave. And Jay Hernandez, tell us a little bit more about Raymond James and your role there.
Sure. So Managing Director at Raymond James. For those of you who don't know the background, Raymond James, we're a global financial advisory firm where we have over 650 investment banking professionals across about 25 offices worldwide. And we focus primarily working with companies in the middle market across a number of active industries, including the industrials, tech and service, consumer, healthcare, energy, financial services, and real estate, as well as retail. And we're cross products, so we go M&A, which is primarily the bulk of our business, but we also then have equity and debt advisory services, private capital advisory, as well as some restructuring. I sit within our industrials group, and I'm the global head for our industrial technology team. It's a sector I've been covering now for 18 years. It's probably closer to 19. I just don't want to age myself too much here, but at least 18 years. May have been one of the first bankers dedicated to the space. When we talk about industrial tech, what we primarily partner with is companies within the test and measurement, the automation, the process metering controls, really the broader industrial Internet of Things type companies.
Okay, thank you, Jay. Yeah, industrial technology seems to be at the center of the action these days. Let's turn to Nadim Malik to introduce himself and present some data to shed light on the current state of the market. Nadim?
Thanks, David. Nadim here. I'm CEO and Chief Spatial Hair Growth Officer of SPS by Bain & Company. Really appreciate everyone joining us today. For those of us in the Northeast, hope everyone's enjoying some beautiful fall weather. At SPS by Bain & Company, we're continuing to do what we do best, which is helping our clients position themselves for relevant deal sourcing opportunities in the current market, or any market for that matter, using data, analytics, technology, and automation. A year ago, when we did our October 2022 panel, I remember the headline was, "Wow, what a difference a year makes." The environment was so different from the flurry of deal activity for the prior year, which had begun tapering off. As I sit here today, reflecting on the last year, it feels like exactly the opposite, as in there doesn't seem to be any difference over the last year, and it's just more of the same. Or is it? Well, I'm really looking forward to hearing the perspective of our panelists who are great at what they do. They've been doing it for a while, each of them grappling with many of the same questions as our audience. But before turning it over to them, I wanted to spend the next 8 to 10 minutes walking through some slides to help frame our conversation, starting with what you see right now, which is overall private equity and M&A deal volume. Deal activity declined by just under 15% last year and is on track for a 15 to 20% decline in 2023. Interestingly, the trend that began in 2021 of PE representing a larger share of overall M&A activity compared to strategic buyers continued in 2022 and so far in 2023, with PE activity representing 53% of overall deal activity for the year. I'm starting to wonder if this trend is going to reverse or not. I can definitely see arguments for both sides. Looking at quarterly closed deal activity on the next slide, amazingly, quarterly deal counts are down every single quarter pretty much since Q4 2021, almost 2 years. PE deal activity in Q3 2023 was down 27% compared to Q3 2022, and corporate deal activity was down 24%. Now, those percentages will decrease as more closed deal data for Q3 2023 is discovered. But looking at the chart, you can see that the percentage decline quarter over prior year quarter for the first 3 quarters of the year has continued to increase as the year has progressed. Q4, as we all know, is almost always the strongest quarter of the year for M&A. And this year, it's going to tell us a lot about the overall health of the PE and M&A market. Moving on to the next slide, here's a look at the most active sectors for Q1 to Q3 2023 versus the same period in 2022, broken out between strategic and PE deals. The industrial sector continues to be the most active, but is down over 20% compared to last year, followed by technology and business services, which are down 20 and 25% respectively. The sectors with the least decline year over year are healthcare and energy. You'll notice that PE has the edge over corporate buyers in all of the top 5 most active verticals, while the financial services, energy, and media and telecom sectors saw a higher share of strategic versus PE deals. Moving on to the next slide, the trend of the buy and build and roll-up strategies, which has been prevalent in private equity for many years now, continue to increase, reaching 2.7 add-ons for every platform in year-to-date 2023, after coming in at about 2.6 add-ons for every platform last year. While firms are still completing add-ons at a more accelerated pace than platform deals, according to SPS's recent 2023 Dober analysis, which I'll get into in a few slides, add-ons actually fell by 40% from the year ending June 2022 to June 2023. Now, having said that, more of our clients are getting involved with their add-on deal sourcing instead of just leaving it to their management teams on their portfolio companies. Moving on to the next slide, breaking down sector activity by the 4 deal tracks, which are add-ons, buyouts, financings, which is what we call non-change of control transactions, and recaps. Financial services saw the greatest add-on activity relative to other deal types so far in 2023, while financings or growth or minority deals continue to remain an important investment strategy in the technology space. Having said that, add-ons comprise the biggest share, if not an outright majority, of all transaction types for most sectors, and are the key contributor behind PE activity outpacing corporate buyers in terms of overall M&A market share for the last 2.5 years. Moving on to the next slide, I'm still really loving this slide, so I continue to ask the team to update it for each of our panels. This shows the most active sell-side advisors, the top 20 most active sell-side advisors in terms of deal count in the US or Canada so far in 2023, further breaking down their activity by size range. I don't know what the right commentary is for this slide. Honestly, it's just fun to look at. I will say that the firm's generational equity and benchmark international really stand out on the lower end of the market, i.e. deals sub 50 million in EV, while JP Morgan and Goldman jump out for me on the upper end of the market. Moving on to the next slide, let's take a look at private equity pipeline data. The median number of deals that a PE firm saw, or more accurately logged in their pipelines, was 211 in Q3 2023, which is the same as the prior quarter, and about 8% less than Q3 2022. It's now been 2 years since deal flow peaked in Q3 2021, as per this chart. While these numbers can't speak for quality, it does seem like pretty decent deal flow numbers purely from the perspective of volume. Moving on to the next slide. Here, instead of just talking about high-level trends and analysis, just wanted to emphasize how important it is to drill down and customize data, eliminate noise to get a clear as picture as possible. Now, whether you're doing it for a sector screen, a particular deal you're looking at, an investment thesis, using the food, bev, and restaurant space as an example on this slide, on the left side, we start with a very broad screen over the last 3 years and cut it down sequentially by size range, PE deals, platforms, add-ons, and growth equity/minority transactions, and then get a 360 view of the market. By that, I mean, who are the key intermediaries that are bringing deals in this space? Who's your competition? Who are the most active buyers? And of course, the capital providers and partners that have been active. I would add one more column to this if we had space, which is an area that's growing of focus for our private equity firms and of course M&A advisors as well, which is who are the private equity firms that have the most holdings in this sector that may be coming to market in the years ahead. It's critical to know your ecosystem and get this kind of 360 view on key potential partners and peers. Now, the final 3 slides are going to focus on our deal origination benchmark report, DOBR, which we call the DOBR. What you see here is a very high-level summary snapshot of this year's results. But first off, what is the DOBR? Well, we've been publishing it for a decade, and it's really evolved into an industry standard offering a detailed review on the effectiveness of a private equity firm's deal sourcing, answering questions like, are they getting better at it or worse? Are they top quartile? Do they need to cover more intermediaries? Are they seeing less deal flow than their peers? And a lot more detailed than that. And of course, the objective is to take this information and apply it to better prioritize time and efforts moving forward. So that's the DOBR. Now let's come back to the summary page. One of the key metrics we use is called market coverage, which is the share of relevant closed deals a PE firm sees that meet its investment criteria. This current analysis was derived from 167 PE firm clients that qualified for inclusion, broken out into 8 peer groups based on size and level of sector focus. And the way this chart flows from left to right, generally speaking, is moving from larger size funds to smaller size funds, which is why you can see coverage drop for firms focused on the lower end of the market towards the right, which you can guess would be the most fragmented and hardest to cover. The dinky deals, as Jay said. The main takeaway here is that most firms are still missing over 75% of the relevant deals they'd like to see. Moving on to the next slide, this is a more detailed set of summary stats on key deal sourcing metrics derived from the 167 PE firms that we included in this year's DOBR analysis. The market coverage box on the left shows what the median, max, minimum, and top quartile market coverage was for different cuts of data. The top section representing when there was an intermediary involved of any type on the sell side, and then breaking that down by boutique versus the more active advisors. As you might suspect, when the seller is represented by a boutique shop, PE market coverage of those deals drops pretty significantly. Sticking on the left side, we also show how much change in market coverage occurred in the last 6 and 12 months, and also market coverage of broad versus moderate versus limited process deals. So these are, as a reminder, these are actual summary stats, but each client gets a customized report and analysis that shows their results and how those results compare to their peer group. On the right-hand side, we're focused on more general key deal sourcing metrics that our clients value that aren't really based on market coverage, like the number of platforms and add-ons closed, your annual deal flow count, and how much of that deal flow is closing to anyone as a metric of perhaps quality of deal flow, which is what we call pipeline closing percentage, how many unique intermediaries show you deals, and the number of BD professionals on your team. Moving on to our final slide. This is just one example of the output a client actually receives as part of their customized Dober report. On this chart, the columns show the number of deals closed by month in their target market, and the color coding represents their interaction with those deals, such as didn't see it, passed, bid on, and closed. The trend line is really the key takeaway here. It's measuring at the data point on each of that month on that line is what share of the last 12 months relevant deals did we see. So the point is, this is an easy visual to assess, like you always want to see that line moving up over time, gradually. All right, enough of getting my data geek on. Hopefully that was helpful for the audience and maybe get some ideas spurred by our panelists. So with that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A.
I got to throw a plug first, Nadim. I've watched you create the Dober over the last, 25 years. And we used it at Audax, we used it at Plexus. And I would say for anybody on this call and is thinking about building really good deal flow, trying to build a BD function without this kind of data would be like trying to get better at golf without keeping score. And to have the measure that helps you see how you're doing in good markets or in declining markets like we're in now is so invaluable. And the alternative would be like me measuring my overall fitness by looking at my weight. It's not a good idea. It's going up, but it doesn't have anything to do with fitness. And that's like raw deal flow in a rising market. And what Nadim and his team have done is unbelievably valuable. And you're stupid if you don't use it, because it's about the cost of making 4 deal visits. Enough of the plug.
Wow. Thank you so much. Drop me your Venmo account info. I appreciate it. Really, really appreciate that.
All right, really good stuff, Nadim. And we're just about to get into the discussion portion of the program where we're going to address all of your questions. But before that, I'm going to try to do a polling question to take advantage of the large audience that we have and see if we can get some market intelligence. So we'll do 2 polling questions. First one is, how do you expect your firm's total number of platform deals this year to compare with last year when all is said and done? So here we go. So go ahead and make your selections. Give you another few seconds. Your choices are down from last year, even with last year, up to 10% higher than last year, or more than 10% higher than last year. All right, more than half of you have voted, so let's share the results. Okay, I think you can see those. Yes, so consistent with the data Nadim was showing about a gradually slowing market. More than half of you expect the number of platform deals that you do this year to be down from last year. Okay, let's go to the second polling question, and this will be very similar, but it's a look ahead. So how do you expect your firm's total number of platform deals next year to compare with this year? So go ahead and make your selections. Again, very similar choices. Your choices are down from this year, even with this year, up to 10% higher than this year, more than 10% higher than this year. Once half of you vote, I'll close the poll. All right. And these are the results. So lots of optimism about next year. Only 10% of you expect next year to be a down year in terms of platform deals. And 45% expect the number of platforms that they do next year to be up from this year. Okay. So with that as a backdrop, let's jump in and start answering some of your questions. I'm going to start with Jay Jester, Plexus Capital, our private equity firm on the program. Jay, what is the quantity and quality of deal flow like out there right as we speak?
The first thing I'd say is like new deals in is just one of our critical inputs. You know, like we're very thesis driven. You know, we're looking at, I call it 650 to 750 new deals a year. Another critical input for us are operators. And we think about sourcing operating talent very similarly to how we think about sourcing deal flow. But just on the, you know, sort of intermediated books coming to us, we're probably down at this point in the year 15 to 20% of, you know, what 2022 looked like. Our visits, which I think of as our most, you know, critical intermediate metric, are the number of times we have Plexus team members in front of the owners and decision makers at small companies, is basically flat.
And Jay, what's your outlook for next year? What things do you think you agree with our audience that things will pick up, or what's your feeling?
You know, and it's fascinating looking at Nadim's data. I think we can now agree that the all-time peak of M&A volume in the U.S. since the beginning of M&A was Q4 21. And we've been in this like steady decline. And it's really interesting. Every other correction that I've lived through has happened fairly suddenly. So if you think about late 08, 09, Madoff, Lehman, you know, that was like a snap, game over, huge decline, and then a gradual increase. And looking back, it feels like it's been a very gradual sort of let the air out of the overinflated balloon, sort of steady decline. And all through that period, you know, every investment banker I talked to, it's basically the same story, which is a ton of interesting companies getting ready to sell. You know, I talked to a guy at DataSite that said they had more data rooms populated, but not yet open than at any time in their history. And so that backlog of transactions that will trade and the massive backlog of capital that is ready to do those deals, those elements are there. And I think it's just a matter of time of enough stability, enough gradual decrease the pressure in the balloon that we turn the corner and you know, and deal activity begins to match the demand and the need for capital, and you know, aging owners and aging private equity portfolio companies that need to transact.
And yeah, Jay, just to jump in here, I think you said a couple interesting things. One, you know, if you look at what we're at right now versus 2021 and 22, I mean, it's down, but to your point, Jester, those were the all-time highs. I mean, 21 almost felt like 2 years worth of deals in 1 year, because you had deals that got pushed out from 20 and they got pulled in from 22, 23 as the markets were off and running, particularly around valuations and buyer interest and the credit levels. So I mean, trees don't grow to heaven, so things are going to regress. But if you look at it over a longer period of time, it's actually, we're at par compared this year compared to what it was pre-COVID, so 2012, or even what Nadeem showed 2015 and 2019. So, you know, I gotta maybe have enough gray hair on my head that I can take that longer term perspective. Now, with that being said, you know, deal volume is down, and down, you know, notably. I found the quarterly data pretty interesting, that it was that steady decline. And I wonder if it has something to do compared to what we saw in 2007, 2009, that severe cliff, or even in the early 2000s, late 90s, where right now, over the last couple of quarters or last 2 years, you've really had a market that didn't know where left or right was going, because the Fed was very slow in increasing its Fed fund rate, kind of throwing out a few foreshadowing there that they may be going forward, but also maybe pulling back. So it's just a kind of an instability over the last 2 years. I think that's really caused this slowdown more than anything else. I mean, the markets never need to be perfect, but they need to be at least stable. And the hope is that, and what we see is that, going into 24, the stability will be there. And we are similar to what, Jay Jester was saying with regards to our backlog is at an extremely high level. But, when we take these things out to market, when we are prepared, or when we feel our management team is comfortable, the shareholders are comfortable with what the company is doing, what the market's going to look like, that'll really be the catalyst that breaks the logjam.
And either Jay, what gives us that stability? How do we know we're in a period of stability? Is it inflation's down, interest rates are down? Like what exactly is going to be that catalyst to get the M&A market moving again?
I don't know if it's any one particular metric. I think it's more of time than anything else, which I get is frustrating, because we as humans always want to have one point of remedy. But the way I think about it is stability is, how have companies performed over a period of time where the cost of capital has been high, where there's been economic headwinds, when there has been some lack of visibility on what the company's going to do over the next quarter or 2 quarters or 3 quarters. So that way the market can see how businesses have performed and how the management team are handling the situations that they're in with their business, with their customers' demands, with inventory levels, and a lot of other metrics. So I'm not sure there's any one given metric we can look at to say there's stability or instability. But Jester, you've been doing this as long as I have, maybe even longer. I don't want to age you, but curious of your thoughts there.
It's interesting. I was thinking about, if you think about the downturn in the global financial crisis, to really 21 was the run of, the bull run of M&A. And almost all of the back half of that, I spent wondering what's going to be the thing that brings this run to an end. And we thought about, at one point it was healthcare costs. It was China tariffs. It was, just everything we went through. And then it was COVID. And then, all the different things that we worried about. And in the end, I think what brought what I think of as modern private equity wave 4 to an end was it was just a sum total of all those things manifested in inflation. And if you think about what we do, we are distributors of capital. Everybody on this call is in that business, and we enter into long-term contracts. And that's one of the good and the bad things about private equity is we're not day traders. We're putting the capital out for somewhere from 4 to 10 years. And when you have that uncertainty where you don't know what the big thing is that you're worrying about, it's harder to commit that capital and sign up on either side of that long-term contract. And and I think about, like, once we tipped over, and it was, we would on the rise up to 21, we would look at all these things and say, is this it? Is this the thing that's going to turn it? And it didn't. And then it didn't again. And then COVID didn't turn it. And now we've gone to this negative mindset, and you think things start to stabilize a little while, and then there's war in Ukraine. And then And then you sort of go, oh, maybe that's not going to kill us. And then it's energy prices. And then it's food prices. And then it's supply chains. And now it's war in the Middle East. And every little thing, when you start to feel some stability in the world, there's a new shock to the system. And until we get our heads around that risk as an industry, I think we're kind of in this gradually letting the air out of the balloon mindset. And I can't think of like one single thing that's going to turn it. It's like all of us getting comfortable that I've got some visibility to deploy this capital and feel good about growth.
Yeah, very interesting. Dave, let's turn to you. What's from your perspective at Hennepin Partners, sort of in the lower middle market, what's the quantity and quality of deal flow out there?
Yeah, I'd say one thing is, the drivers of deal activity in the lower middle market are sometimes totally different than what drives the upper middle market and the large cap market. When you think about an entrepreneur or a family-owned business, there's lots of reasons they sell that have nothing to do with what's going on in the market. They have transition issues with the family, an elder parent that wants to get out of the business, children that don't want to run the business. And I will say in all the years I've been doing this, the entrepreneurs always seem to be 1 to 2 years late. They hear about all the great valuations that are in the market. And if you can time it right as a banker and get them level set that those multiples were available in 2021, they're no longer available, but there's still a market. Deals are still happening in the lower middle market with entrepreneurs. One of the things to follow on what Jay and Jay were talking about that I found interesting was, and PE is what's driving the lower deal volume right now. Deployment rates across PE are down roughly 50% from third quarter, fourth quarter of 2021, but realizations for PE groups are down close to 70%. And so PE groups are sitting on loads of assets that have been held for a long period of time. And I do think that when the bubble bursts in the deal market, it's going to be PE driven. The sponsors that I talk about, the bankers that I talk about, everyone echoes what Jay and Jay said about having huge backlogs of deals that are ready to be launched and waiting for the time. And I do think, I think Nadeem mentioned Q4. I don't think Q4 is going to be any better than the rest of the year. Most groups that I'm talking to, feel like there might be less closings in Q4 this year than potentially Q3, but everyone's sitting on a huge backlog, and clients are asking, should we be the first out? Should we wait? Should we, it's an A plus asset, you don't need to wait. But for a B minus, C plus asset, everyone's cautious and wanting not to be the first out.
Hey, Dave, as you know, private equity firms, if they really love an asset, they could potentially create a continuation fund, sell it to the continuation fund, and then kind of stay in control of the asset. Is that happening enough that it's having some kind of real impact on the M&A market, or no?
That was the exit du jour, if you will, in 2021. People were rushing to do it. I think LP interest in the secondary market started to dry up late last year, and it hasn't been nearly as active as it once was. It's still an obvious exit. We don't do that here at Hennepin, but Lazard had a big practice in that market, and I would say their deal volume is down considerably over the last 2 years.
Yeah. Interesting. All right, let's turn to Nadeem. Nadeem, just curious from your perspective, with all the data that you're constantly analyzing, what do you see as the quality and quantity of deal flow right now compared historically, and the outlook for next year?
Yeah, this is just a fascinating conversation, and I value the perspectives from the people with the feet on the ground. You know, data is great, but data needs to tell a story, right? What is the story that the data is telling? Maybe it can't predict something, but it can help you be as smart as possible with that story and that narrative. So, you know, I am curious about the positivity about next year's deal activity as indicated by the poll results. I think it was basically 90% saying it's going to be at least as good, if not better, than this year. So I get the dry powder buildup. I get the need to put that money to work. Having said that, you know, just the interest rates aren't coming down next year. I think everyone can kind of agree to that. The cost of capital is going to be significantly higher for PE firms to do deals and get the kind of returns they were expecting. Let's face it, over the last decade, like private equity firms benefited from just continuous multiple expansion, you know, for year and year again, and it just makes things a lot easier to drive returns when you have that kind of multiple expansion stuff. So of course, there's great companies that are going to thrive. I think certain private equity firms maybe aren't going to be equipped or really interested in trying to overcome the higher cost of capital, really get into their portfolio companies, cut costs to make up for that, wait for interest rates to come down, recap. There's definitely opportunities here, but I think the tricky part is, especially on the private equity exit side, what's going to be the multiple? What's going to be the clearing multiple? And how is that going to drive fund performance, distributions back to LPs willingness to commit into GPs? And so that's the question mark. I see the hope and optimism and the accumulation of capital on the sidelines certainly is a strong thing, but the math is still eluding me in terms of deal activity with these types of interest rates and growth, you know, economy growth rates and whatnot. So I don't know. I guess I'm just looking for some rationale to justify it beyond just the need to put money to work. Maybe the other panelists have it. I don't know.
Yeah, I'm taking all that nice stuff I said about your I'm taking it all back. That's just the most depressing read of this awesome market. Come on, Nadeem, what the hell's wrong with you? I mean, my counterpoint on that is when you look at the alternative places where an institution or an individual can invest capital globally, like the U.S. middle market with every resource that we need within arm's length. And you can say whatever you want about the turmoil in the U.S., but political turmoil in the U.S. doesn't even move the needle on the rest of the planet. And the world's oldest democracy, a continuing healthy population pyramid in terms of growth, you know, you have everybody in the world risking their lives to figure out how to live here in a world where that's hard to find who's number two with that dynamic. And I do think as like global supply chains get increasingly complex, as you know, we're energy independent, and as the U.S. military complex backs away from making shipping free for everybody else on the planet, this is an awesome place to invest. And I think we're seeing it. It is relatively flat right now, but the idea of helping these small businesses and feeding them into just the unbelievably deep equity ecosystem that has effectively replaced the public markets, I'm more optimistic than I think I've ever been about deal activity. Yes, there is a lot of headwinds and turmoil, and we're in a lull right now, but over, I think, the rest of my life, I can't think of another place I would rather deploy my own personal capital than, you know, U.S. lower middle market.
Say, Jay, Jay Jester, we did get a question from the audience about how your portfolio companies are doing, which sectors are strong, which are not. So be thinking about that. I'm going to come back to that question in just a couple of minutes. But first, let's turn to our investment bankers on the program and talk about industries and subsectors that are generating deal flow for private equity sponsors. So what's still active or relatively active out there, and why, and also what's cooling off and what's cooled off, and why. And we'll start with the lower middle market, and then we'll make our way up to bigger deals. So let's start with Dave Santoni.
Sure. I'd say in the last 3 quarters, where we've seen the most activity is on the services side, whether it's industrial services, business services, tech-enabled services, not the asset-heavy businesses like the general industrial world. And we're a very heavily weighted industrial bank. We have 4 MDs that focus exclusively on industrials, but even their practices have morphed more towards the service side. Software and tech has still been strong. Those have all been historically more growth equity related and less reliant on debt. Valuations are certainly down in the software space, but when you're thinking about getting a deal done, they generally don't require or look to debt to get those deals done. Consumer is really slow at our firm, and healthcare, on the services side, still okay, but generally down as well.
Okay, and what's behind the slowdown in consumer? I mean, we just saw really strong numbers come out today for economic growth, just crazy high. So where's the disconnect there in the consumer deals?
I think some of it is, Jay Jester mentioned just the things people were worried about as inflation was being talked about and looming recession and consumers pulling back. They don't seem to be pulling back. We seem to be past it. But, over the past 12 to 18 months, people looking to invest in the consumer sector really slowed down just with looking into the future.
Right. Very interesting. Okay, so let's turn to the larger end of the market. And Jay Hernandez, what industries and subsectors are still generating decent deal flow, and what's weak right now?
Yeah, I mean, we're still seeing a solid activity across a number of sectors. I can speak very knowledgeably about industrial technology, which continues to be very active. Now, these companies tend to perform fairly well across all economic conditions because their solutions tend to be seen or are compulsory in nature. Could be sensored instruments that are monitoring the quality of food and pharma applications. It doesn't matter if the market's good or not. Those type of technologies or type of solutions are going to be needed, or even energy meters and controls within the power grid. So if you even look at just industrial tech, the market is slowed, but not as much as the overall market's down about 10 or 15% versus the 30 or 35 that we saw from the broader market numbers. From my colleagues around the horn, I mean, we're still seeing about a good amount of activity in security and safety. I mean, that's almost a market that does better in a down situation or in tougher economic conditions. Business services, much like Dave said, industrial services, commercial services, HVAC work, landscaping, any kind of building automation services, those continue to do extremely well. Aerospace and defense, our team is extremely active there. I think that's related to global geopolitics at play, and the continued investment within military applications and within the military force. In the tougher markets that we're seeing, energy and power for sure. People are worried about the pricing of oil and gas, whether it's petroleum or natural gas, and what that means for those markets, which those energy and power is fairly cyclical to begin with. but that's notable in its slowdown. A little bit in healthcare, on the services side, on the software side, still seeing a lot there. Consumer a little bit, but I'm not as close to that as maybe what Dave is in his platform. But overall, I mean, again, things are good, not great, across all of our teams, and we continue to have cautiously optimistic views here in the next 12 months.
Okay, yes, does sound reasonably like a reasonably strong picture. Jay, Jester, let's turn back to you and address this question from the audience, which is how are your portfolio companies doing? Which sectors are strong and which are weak?
So we've done 7 deals in the equity fund. We probably have 80 positions through our credit-led business. I would say, like others, consumers, consumer-facing stuff is probably the weakest, and where we're seeing the most excitement would be like route-based services and industrials would be the best performers at the moment. And again, it's one of the things I love about the small deal market is, it's more stable and more sustainable equity multiples, debt multiples, and just tons of levers to pull. So finding these small businesses with a great leadership team and really a spirit that's open to, they don't do a deal with us if they're not saying, hey, we need the help. How can you help us? And we've got a really deep network of operating partners who have been at big companies, at Pentair and Precision Cast Parts, and they're people that worked inside big organizations and know what great looks like, but they also love working with small businesses and are willing to roll up their sleeves and help. And just to be able to help these small businesses optimize on a lot of different levels is why this works. And then I think the other thing, the 2 jobs that we have is we make a platform. That's job 1, and that's usually the hardest part. And then the part where we really shine is then we get to act like a platform. And to have both of those levers, I think almost only exist in the dinky deal market. And I think that's where we're finding our success, is bringing all of those different levers and just figuring out what are the optimal ones, to pull for the situation you're in at the moment.
And thank you, Jay. And Jay,
hey, Jay, just a quick question.
Go ahead.
Sorry, Jay, just a quick question for you. I mean, as you think about your operating partners, which is a pretty unique model to have, and I think the private equity groups that we work with that have that kind of model do extremely well. But as you think about your operating partners and your management team in this market, how are you evaluating those teams now? Because what we've seen is a lot of these executives now are maybe young enough that they haven't experienced this type of market before, particularly like a CFO or a COO. So how are you looking at your management teams right now? How are you thinking about your operating partners? I'm assuming you're putting a lot more stock in those right now, but curious on your perspective there.
Yeah, and I think we've built a talent pipeline that's very similar to our deal flow pipeline. And I sort of think if you look back to previous private equity waves, at one point it was like, okay, let's see more deals, and that's great, but to go out and say, let's really be methodical in bringing in hundreds and hundreds of executives that are referred by you and Dave, like, hey, this guy was running a great company, got bought by a corporate, he still wants to live in Charleston, you need to meet this guy. And it's not just great, we got your name, if something comes up, we'll think of you, but our lead operating partner is running these people through a pipeline of 7 or 8 methodical steps that include like dinners together with Plexus partners and their families, to evaluate and say, are these our kind of people that are going to fit with the kind of companies that we're investing in, that know how to make change, but also know how to do it in a graceful coaching way as opposed to a dogmatic directive way. And then check references. And it's a slow process, but it's very methodical of going through those executives, And I love on our debt side of our business, there's a bunch of and it's really important work, so I don't want to diminish it, but it's sort of like tryout opportunities where maybe they could be a board member in an area where they've had great success, and we get to see them operate with a team, sort of elevating towards, ultimately the 5, now 6 senior operating partners at Plexus have sort of come up through that ecosystem, where there's a lot of team trust, and it's the funnel on that, the metrics on that funnel look very similar to the funnel that we've developed around, the number of deals that we sign an NDA, take a visit, IOI, LOI, on through the steps. The two tracks are very similar.
Thanks.
And thank you for the referrals. Keep them coming.
Jay Jester, I want to stick with you for one more question, because
I got on my soapbox about how great America is, and now everybody's coming at me. I love it.
As a private equity firm, you're obviously doing both buying and selling. And so in this market, are you a buyer? Are you a seller? Are you both? What are you, Jay Jester?
I'm a buyer right now, just because everything in the equity portfolio is new. And one of the things that really drew me to make the move, I had an unbelievable 20-year career at Audax. That was just one of the coolest experiences of my life, was to work with that team and build what we built there. And as an old man, for what I call my third chapter, to go back to North Carolina and get to try to do that again and be a part of something like that in the small deal market has just been great fun. And I think what I've learned is, in our business, we are always buyers. And sometimes it's more focused on platform companies, and sometimes it's more focused on add-ons, like in the 2010 to 2014 timeframe, where the transformative value that we created at Audax was almost exclusively through the add-on acquisitions and the support of our existing portfolio companies. The other thing I've learned is, I think it's tempting to sit around and wait. Like, I can't wait until there's a buying opportunity, until the market dips and all those great companies that I couldn't buy because Jay and Dave were selling them at crazy numbers and hyper competitive auctions. Like, that just doesn't exist, or it would be happening right now. But the beautiful thing about the business is, like, very rarely does the owner of a private company have to sell that private company. And so the very best companies right now, as we've all talked about earlier, are simply not for sale, or you have to be willing to pay a ridiculous number off of a trough EBITDA to make that company transact. And so I think that taking that long-term attitude of, very little gets done at either the bottom or the very tippy top peak. And we're buyers in the shoulder season, either, on the way down, when you have an optimistic view about what's coming next. That's when a lot of transactions happen. And then as you make the curve and you start coming out of that, and I think the smart money are the buyers. And I'll give a shout out to Pam Hendrickson's firm, Riverside. They were a wonderfully aggressive buyer, to my recollection, coming out of 2008, 2009, in a bunch of deals. They were ahead of the curve. And I think that's the market we're going to be in now. Is it's going to start to come back, and people are going to chase price and hold back. And I think some of the best deals will happen, from now until we see that upward turn. You asked me a simple question. I went on way too long. I'm a buyer.
Okay. And just connecting a few dots on things I heard earlier. Sounded like consumer deals very slow, but also weak performance. Maybe there's an opportunity to buy low and ride things higher. But let's turn to artificial intelligence. We can't have a webinar these days without talking about AI. And Nadim, I want to get your expertise on this. We had a lot of questions from registrants when they signed up about AI. One of them was, how far has AI use developed in accurately identifying macro and micro trends and discovering and tracking nascent areas of deals? Tell us what you're thinking, Nadine.
Yeah, we're looking at AI, especially over the last few months. And I have multiple hats on. I'm looking at our own business and our data collection process from the perspective of how can we create efficiencies, how can we leverage these things, and always thinking about competition coming in to be ahead of the curve in AI and being able to create similar data or better data or whatever in a much more cost efficient manner. So we are exploring that. And then also, what would AI look like in addition to our offering, as an adjunct to our offering for our clients? So how should we be applying AI to improve and optimize the user experience to give them an edge in what they're trying to do? So we are full throttle in exploring both of those things. And this is not that I could have forecast this, but this is one of the great benefits of working with a company like Bain, having Bain as a parent and being under their ownership. Is obviously Bain is the top consultant to private equity firms for many years, and they are viewed as the thought expert and putting a lot of resources and partnerships and whatever they can do to answer all the questions that private equity firms have. And it's starting with their own portfolio companies, not necessarily the private equity funds themselves, and how they should be thinking about AI. So from what I'm understanding and I'm learning, we've had guest speakers come in. We've had the experts at Bain come in to talk to us. We're in the throes of figuring all of this out right now. I do think this could be that one catalyst or part of the reason that there's an opportunity for growth and acceleration, especially for large companies, but I think it'll trickle down to the middle market eventually. It's just slow moving. I think it is very important for everyone to be thinking about this. Naturally, I think there's a fear factor that comes in. So I think private equity firms first start with looking at their portfolio companies and saying, is AI a threat to any of these businesses? And there's certain obvious spaces where I think it will be a threat, and they're trying to figure out how they can change the business structure or model that. But I think the second tranche is, okay, we've got that covered. We're going to do whatever we can. How can AI improve, my portfolio companies? How should I be looking at different companies? And this is very much in the early stages, but we're in the middle of it. We're trying to figure it out. I don't think it's a predictive tool. Like that's from what I'm understanding, AI should be viewed as a way to predict what stocks you're going to be able to, are going to drive the best returns, or what sectors, or what, that kind of thing. It's just getting information faster, deeper to make smarter choices. So that's what I would say about AI right now.
Okay. Anybody else could jump in with an AI success story if you like. But in the meantime, I just do want to encourage everyone on the program to get your questions in. We have about 10, 12 minutes left in the program, and we want to make sure that we do get to all of your questions. So we'll make this a last call for questions. And also want to get to deal sourcing strategies, which are effective today, and maybe some that are not so effective anymore. And for that, Dave Santoni, let's start with you. What's the best way to get on your radar, stay on your radar, make sure they don't miss any deals?
I like to think we're pretty good at getting it, and based on the amount of times I get an email from a private equity group that's driven by SPS saying, why didn't we see this deal? I think we're doing a pretty good job of getting deals in the right space. Those emails, I always laugh because it's typically a deal, and I feel really good about this, that was a one-off process or a strategic only process. So we generally are able to give people a pretty quick answer. this is, people don't like to hear this. It's a relationship driven business, and the people that are good at it build relationships with bankers that show them quality deal flow. And the good thing about us at Hennepin, I mean, we've all been doing this 20 plus years, and we all have unique relationships and get calls routinely from groups and do a good job of keeping in front of them. You really do need to put in the effort to build long-lasting relationships in this industry. And my guidance always for young bankers was, every time you're working on a sell side deal and you're interacting with a private equity group on the other side, they're a potential client. Don't think of them as just a potential buyer on this deal, but they're watching the way you behave. They're listening to how you treat them, and they need to be treated as if at some day they're a potential client. And over time, you will build those relationships. We just closed a deal 2 weeks ago with PNC River Arch in Pittsburgh. I've known Mike Rost for 15 or 16 years. We've never done a deal together. We've never sold a company for Mike, but we built a deep enough relationship together that when we had a deal fall apart with a strategic buyer, we were able to go to Mike and get a deal done at a very good price and very quickly. And without that relationship, it wouldn't have happened. So I do think people need to recognize the power of relationships in this market.
And Dave, before the program started, we found out that you have a big interest in horse racing. Is that a key to a good relationship with Dave Santoni?
No, I keep that to myself. I have not participated. I have one client in Dallas that's a family office, that the patriarch is a large horse racing owner and breeder, but that's not the way we met one another. It just turned out that we both had similar interests. That has not been a driver of business.
Okay, that's good to know. And Jay Hernandez, same question. What's the key to developing a good relationship with you, making sure that you're going to see the industrial technology deals that are in their wheelhouse?
Yeah, I mean, I'd echo Dave's comments, 100%, if not 1,000%. I mean, this is a, excuse me, this is a relationship business at its core. And as we as advisors are advising our clients as far as potential partners for their company or potential buyers for their company, we have to be knowledgeable on what groups are looking for, what they're, how they act or how they react in processes and our work efforts with them. But sometimes even more importantly, where they have built in a knowledge base around. I mean, what Jay Jester and those guys are doing at Plexus as far as being thematic and having operating partners is an extremely valuable way to go, because that way, when I talk to Jay, he's like, listen, we're working with, so-and-so from Amatec or so-and-so from Pentair. Here's our theme, here's our thesis around this. And we can develop a conversation, develop a knowledge base around that thesis and what they're looking for. That way, when we're working on a deal, we can come to Jay and say, listen, here's what we're working on. We're working on a flow meter business, fits extremely well with the operating partner you have from Pentair, who did X, Y, and Z. And I have then a comfort level that, listen, Jay and his team are looking at this deal through educated eyes and are going to be able to bring that base of knowledge forward. So it's really getting out in front of bankers at all times and making sure that we're aware of where you've spent your time, where you have gone deep in with regards to either your investment efforts or your research efforts or operating partners that you have in your Rolodex. I can't, overstate the importance of that, because without that, you're just another name on a list. And when deals get done, they're often done, or choices are often made on the margin. And so the more information we have about you as a group, as an individual, about where your investment efforts are going, the better we can advocate for you to get on a buyer's list and advocate for you to be in a process.
Yeah, and one more thing to add. I mean, similar to the metrics Jay uses as they're looking at deals. How many LOIs did they submit? How many deals turn into? We track that as well. So, we can look over history at every deal we've shared with a group and how far along they made it, and give them real feedback. Like, look, we keep showing you things you never bid, or you bid and then you backtrack after your bid. We need to get better at that relationship, or you're going to not be on a list. I mean, that's important. So we track very similar data, and know and can share with clients when we get initial indications on a deal and we get 28 indications. Look, this group tends to always be at the top of every list, and they tend to come in 10 to 15% below when they submit a final LOI. And sometimes that doesn't matter. They're so far higher than everyone else anyway. But it's important to know that from the sell side perspective as well. And we track data up the wazoo.
Yeah, absolutely. That is very good to know. And Jay Jester, I'm really interested to hear from you about deal sourcing strategies that are working today, what's not working anymore. What's the answer?
It's a game of inches. Like, if there was a magic bullet, I feel like that is where we are using AI and it's basically more sophisticated. Like we've worked internally to create what I would call the more like this button. So where we can find the perfect add-on that's really small, that has a crappy web page, but we can use AI to pull a whole bunch of different license registrations and business license data sets combined with a web page to say, no, this is actually exactly what you're looking for as that small add-on target. That's where the technology is making a difference. And to me, that's a two-step process of creating a really comprehensive data lake, and then using AI to analyze the data lake and narrow it down. But then once we narrow it down, we go old school. We pick a really good buy-side intermediary, because a human needs to talk to another human to tell our story and do all the things that these guys were talking about, to get on the phone and represent, like, hey, these guys from Plexus, you're going to love them. They're laid back. They're really interested in working with a company exactly your size range. Like, I haven't found a machine that can do that yet. Another person does it. So it's that combination of leverage creating technology. And I love the acronym, like artificial intelligence. Let's hang on the artificial word. The real intelligence, in my experience, comes from people. And one person talking to another person, adding that overlay of trust and experience, combined with the leverage creating data tools. That's, to me, what's working for us, and creating a really broad network, and being really thoughtful about preserving your reputation. Because as these guys, they have all the same data on me, and if we're bad actors in the market, that will follow you around for 100 years. And if you're a good partner in the market, that will be an edge and will break a tie in your favor for 100 years.
Nice. Okay, so we have just about a minute or two left. So I need you to keep the next, we're going to do a lightning round. I just need you to spend 20 seconds on this question, each speaker in turn. And that is, what's a favorite portfolio company or client portfolio company? And just really quick, what do you like about it? Jay Hernandez, let's start with you.
That's like picking your favorite child. That's almost an impossible question to answer. Maybe I'll borrow the Tom Brady or the Bill Belichick. What's the best one is the next one. So in all seriousness, I mean, we've been fortunate enough to work with a number of great companies and have partnerships currently with a lot of great companies, a lot of great management teams. I don't know if I'm going to kind of dodge the question here a bit, David. I'm not too sure I have a favorite portfolio company other than the relationships I have and then the people that I've built those relationships with and people that I enjoy working with and that I trust. Those ultimately are always then my most favorite clients and most favorite companies.
Okay, well said. Dave Santoni, you want to give us, can you give us a name?
I'll go with the easy answer. The most recent deal that I closed was a company called Bar Geospatial Solutions that was a really cool technology enabled service business that provided LiDAR and advanced imagery for vegetation management, utilities, and pipelines. It's my favorite because it was the last one that closed.
Vegetation management, is that like keeping the weeds off the
No,
equipment?
they're able through aerial imagery to measure encroachment by trees on power lines and get the asplins of the world that cut trees down to get to the place quickly and make sure a fire doesn't happen.
Nice,
Really,
very cool.
You
Jay
could do
Jester?
an entire podcast on that deal, the owner of that deal, and the history, and what a great story that is. One of my favorite humans in the middle market put that all together.
Yep.
Ed Fierstein. Everyone on the Plexus team and everyone in my extended family knows what I'm going to say to this one. My favorite deal ever is we bought a company called Cozzini Brothers and backed one of my favorite humans, a guy named Oscar Cozzini, who built this business, basically sharpening knives for restaurants. And I love it. It's a route-based services business. It is an unbelievably simple business. You know, as a guy who spent 4 decades searching for interesting niche businesses to realize that this one was literally under my nose about 4 nights a week for 30 years before I got introduced to it. And it's just, it's a great story. We started with a business in Chicago and did 26 add-on acquisitions and built a national player and just a beautifully simple and elegant business. It was a great deal for Audax. And I continue to stay in touch with Oscar, who's the real most interesting man alive. He's just an awesome dude and has been a great friend for lots and lots of years.
Very cool. Cozzini Brothers. All right, well, I think we'll let that be the last word of the program. And I want to thank everyone for coming. I'd like to thank our sponsor, SBS by Bain & Company, for making the webinar possible. I'd like to thank our speakers for doing such a great job and all the preparation. Jay Jester of Plexus Capital, Jay Hernandez of Raymond James, Nadeem Malik of SBS by Bain & Company, and Dave Santoni of Hennepin Partners. Everyone enjoy the rest of your day. Take care.
Thanks, David.
Pretty much.
Thanks, everyone. Take care.